The late great economist Milton Friedman once said, "The stock market and economy are two different things." We now find ourselves in a particular market dynamic, or at first glance, the price action may not make sense. But reading between the lines, it could actually be a warning sign of what's to come. The COT report helps us demonstrate exactly that. We're talking about the Commitment of Traders report. It was released on Friday, every Friday, showing us by the CFTC the positions held in the futures market. These are held by the largest participants out there, the traders, hedge funds, banks, even farmers. It shows us market sentiment, trade signals, and essentially where the smart money is going. We're going to show you exactly that. In terms of commodities, well, there's bearish bets on natural gas and bullish bets on metals. This is the managed money. These are the largest asset managers in the world. In blue, we show long positions. In red, short positions. Now, in particular, notice the metals, gold and silver. Much higher long positions than short positions as traders continue to bet that the metals are going to go even higher. Now, at the same period of time, natural gas, along with many other energy markets, is heading lower. At least that's what's suggested by the asset managers held in the COT reports. The red bar shows us a significant short position, far more so than the long position. Now, there's also commercials reported. The commercials are the hedgers. They oftentimes take the opposite side of the market. As their clients go long, they invariably go short. It's a little bit more difficult to interpret, but essentially it shows us that gold and silver, well, there's more bearish bets. But that again, that doesn't necessarily mean that gold and silver are going to go down, but rather that the clients are going long, that the commercials are taking the other side of their trades. Now, natural gas, there's a mixed market, slightly larger short position than long, but not enough really to draw any conclusions. But let's dive into the details and show you what's developed this week. And there are implications to this that we're going to talk about. Here's gold. Notice the blue bars rising to 161,000 contracts, higher than last week's 160,000, not much higher, but certainly an increase from 2 weeks ago where we saw only 148,000 contracts. Compare that, by the way, to the red bars at the current level, only 37,000. There is a rising bullish bet on gold, but also silver. 60,000 contracts on a long position versus the 12,000 short position. That's higher than last week's 59,000 and much higher than the 49,000 reported 2 weeks ago. In fact, we're seeing higher highs than we haven't seen in quite a long time. Here's natural gas. Notice the short position, that big red bar, 251,000 contracts, much higher than last week's 215 and the highest high, again, we've seen in quite a while. Very interesting dynamic that traders continue to bet that the metals are going to go higher while energy markets, in the opposite direction. Now, the COT report also tells us about the FX, currency market, foreign exchange market. And the bets that we're going to show you here are showing that the dollar is going down, at least that's what they think, and the euro is going higher. These are the asset managers, the largest traders in the world. That long blue bar, that's the euro. Those are bullish bets. And they're basically anticipating that the euro is going to go higher. Notice the dollar, it's negligible. Now, we know the dollar's been in a long-term trend to the downside. There's not a significant bet on the dollar, but that doesn't necessarily tell us that there aren't large bets. It's just that there's a lot of cross currents out there. Now, these are the dealers, the equivalent of the commercials or the hedgers. And notice there is an almost perfect inverse relationship, meaning that there's a big red bar on the euro, and that shows us that while the traders and asset managers are going long, the dealers on the other side, they're going short. Well, they're not betting that the euro is going to go down. They just sometimes naturally take the opposite side of the trade. But if we look at the charts, we know that the euro has been very, very strong lately. Diving into the details of the US dollar, in particular, notice the bearish bets. Those are the purple bars, basically anticipating that the dollar is going to go down. 10,600 contracts, higher than last week's 9,100. And we can see over the past month or so, there continues to be an increase in bearish bets, anticipating the dollar is going to go down. Here's the euro. Really no development. There has not been an increase on the bullish bets of the euro, but there hasn't been a decrease either. And notice that big green bar, that's much higher than the purple bar, meaning that the longs, well, they continue to maintain their long positions, not adding to it, but assuming that the euro will continue higher. Now, the overall market trend in terms of stocks, Fed futures, they're anticipating no interest rate change in July, while the S&P 500 and other equity markets continue higher. The blue bars show us a probability the Fed will not cut interest rates in the July meeting. We're very close to the June meeting. July is the next one down the road. 88% chance the Fed will not cut rates in July. The yellow line is the S&P 500. Notice a very strong correlation as we continue to see, and this is a pattern we've spoken about for months now, that the Federal Reserve will not cut rates, stocks continue to climb higher. There's a message in this. The stock market likes the current environment. It's not scared about surging inflation. It's not concerned about a crashing jobs market. We're kind of caught in the middle between the two. There's not a strong enough signal in the economy to scare stocks lower. So, in the absence of that, stocks continue to trend higher. And there's no reason to believe in the near term future this will change. Again, there's a strong correlation to the upside between the probability the Fed will not cut rates and stocks moving higher. Now, there's a message behind the prices, and we're curious to hear your opinion about this. Number one, stocks moving higher. Again, there's a relatively stable economic environment. We don't love the jobs numbers, and well, inflation is probably still too high, to satisfy us. But nevertheless, the environment for the stock market, especially technology stocks, we spoke about recently in ETF review, they seem to like this dynamic, and they continue to move higher. Here's the S&P 500. We've pretty much recovered completely from that, the tariff crash we saw a couple months ago, threatening almost new highs at this point. Now, the second point of the message is energy prices. There's falling demand despite tensions, despite geopolitical tensions, which seem to be all the headlines these days. And that is a very important point that should be mentioned. When the market ignores bad news, it tends to go higher. When the market ignores good news, well, it may go lower. Well, notice crude oil, and I know we've had a surge recently, but a long-term 2-year chart, it shows us we haven't really broken this pattern at all. And remember also, the natural gas bearish bets. The asset managers, the largest traders in the world, are increasing their bets that natural gas is going to go lower. Here's gold, on the other hand, triangle consolidation pattern, but it looks like it wants to break higher. And silver has even better charts. So from the market's message again, metals are going higher. Now here's the question. Is this the result of geopolitical tensions or the risk or the anticipation of inflation? If it's the former, why are geopolitical tensions not scaring energy prices up? If this is a question of inflation, well, why aren't the Fed funds futures reflecting that the Federal Reserve may raise interest rates? Well, maybe essentially they are, in the anticipation that the Fed will not cut rates. Maybe we're leaning closer to an interest rate hike down the road. Is that the market's message? Tell us what you think. What are the implications of rising stocks, surging metals, and a weak energy market all at the same time? We'd love to hear what you have to say. This week's economic calendar, Tuesday, U.S. retail sales, industrial production, capacity utilization, lots of manufacturing data this week, home builder confidence, and then we have building permits, housing starts, and a really big Fed decision on Wednesday as well. We hope this has been helpful. We look forward to seeing you back soon.